recording going. Before I start, I want to wish everybody a happy Thanksgiving this week, and we'll get started. I got an email last week from one of our participants, and I didn't see it until afterwards. And so I wanted to, it was a request for going over some information, and I think the information is significant enough that I want to cover it with everybody. I mean, normally I try to anyway. The subject matter has to do with amplitude, cycle dominance, and ways of determining amplitude, and also a statement that Martin Armstrong made, where Martin Armstrong claims that time supersedes price. Well, this idea actually is older than Martin Armstrong, but I know he has said it. But it goes back to W.D. Gann, and he was very cognizant of the fact that that there were two main. Pardon me for 1 second. I'll get it later. Just dropped some papers. He was very cognizant of the fact that there are two forces, one for time and one for a price. And he squared time and price, as you well know, and he used all kinds of Gann techniques. And I've often thought of putting some of those into the program, but there's so many Gann programs I haven't on, but and there's so many different Gann techniques that you can use to do that same thing. Any case, I want to address especially the idea of price. Excuse me. One second. But the first thing to do is we generally default to logs. This transformation section, let me go over that with you. Sometimes people don't use it. Sometimes they use it. Some people just leave it on the default, which are logged. And I'd like to kind of go over the history of how we have found cycles over time. Originally speaking, the original software that the old Foundation for the Study of Cycles developed, not the new one, it was developed in parts. They had a spectral analysis program. They had a statistical program and a periodogram program. And we've combined all those into one. We use them all together. And so it's seamless for you. But in the old days, what they would do is, firstly, it was very time consuming to find cycles with or without software. And what they would do is, if they were looking, they would then march through the data looking for possible cycles. The way they would do it is they would do a spectral analysis of the data, and if there were any amplitudes, high amplitudes, they would use those to search for the cycles. Now, in order to definitize and find these cycles, they would have to first take logs, second, detrend the data by taking departures from a moving average, that is, subtract a moving average from it. That would take out all the cycles but the length of cycle you were interested in, and then they would do their statistical analysis. Well, that's very time consuming, and it isn't really necessary now that we have fast computers. But that's what all of this transformations is about. Normally we take logs, but we can put none on. And then I'm going to go in and we'll put in, we'll do an analysis with no transformations whatsoever. Now, the reason why you would do this, one of Vincent's questions was, do you or have you ever used amplitude in cycles to help in a determination of slash expectation of how far a move can or will go? And the answer is yes. And let's go and look at our cycles here. And you can see all these cycles are sorted by the probability test, the Bartel's test that we use. But we have other things. We have something we call strength of the cycle. It's what they used to call slope. In other words, if you have a cycle that's, well, let's just sort them. Here's a cycle about 95, one at 104. You can see the amplitude of the 95 and the amplitude of the 104 are very, very different. I mean, they're 100 points different. And in the same way, 116 has a higher amplitude. If you come down to these two, you can see there's barely any difference here between this 82 and 77. And what slope is, you divide the amplitude by the length of the cycle. Now, we put a constant in it, so the numbers are large, so it's easier to see them right here. But this is just a constant. We can drop it down. And the key is this strength number, and we'll sort this by its strength here. You can see that these are the strongest cycles. Now, Vincent also talked about dominant cycles in his note. So I hope I'm not skipping around too much, but I may go back and put slope and maybe change the name back to slope. It's an interesting concept. I call it strength. It's the same thing. In other words, if you look at this cycle at 40 and this one at 159, we'll put them both there, and then we'll view them. I have three there. Sorry about that. The slope means that it gets to a very high amplitude very quickly, and this is then this in the blue, as you can see, and we'll go back. You can see it again. This 159 has a strength of 4,400 approximately, and this one has 4,600. So the smaller one, in other words, well, I wanted to show. In other words, this amplitude of 189, and this is 700. The theory is, and this concept goes back to Hurst as well. I mean, all cycle people have always talked about slope. I asked Gertrude Shirk early in my career. I asked her if slope was important. She said it's the most important thing. And essentially, as you can see, this is the, pardon me for skipping, this is the period, this is the, my mind is a blank today, I don't know what's going on. But this is the concept that Hurst used, and he called it the principle of proportionality. In other words, the amplitude of a cycle should be proportionate to its length. If you have a cycle, for instance, you have this 40. Now and you take the 159, this cycle 159 divided by 40. That's almost 4 times further. And you take, and it's actually 3.975. And if we take this amplitude of 189.75, and we get a uh, um, we get a uh, uh, for this. I'm sorry. 159 is 3.95, 3.9 times longer than 40. The amplitude is not 3.9 times longer than 40. So that's the idea of proportionality. According to Hurst, it should be. And according to strength, you can see that this 40.9 is stronger, the slope, what we call strength. And don't forget, our strength is not simply division. We put a constant on it, as I mentioned. Maybe I'll take the constant out. Sometimes the numbers can be very small and it's hard to read them, so that's why we put a constant in it. But the other issue is, of course, these amplitudes now are amplitudes in real prices. Now, this is the cycle we use all the time, 38.2. And you can see it has a very good and very strong strength number. In other words, we think it's when there's not a lot of difference between 44 and 43. So that's basically it. So now this 38 and 40 are really the same cycle. And we have found over time that the slightly shorter 7-week cycle is a little stronger and better overall than the 8-week. But sometimes the 8-week does well. Now let's put them both out. You'll see what I mean. You can see when they're together, they're together. And at this point in time, the phasing of the 8-week is a tiny bit better than the phasing of the 7-week, but they're basically the same cycle. And if we put out 5 years, you can see. And now the way you can see it is if we synthesize these two together. See how they have these higher amplitudes and they come back and they flatten out. This is when they're opposite each other, and like this time, and like this, and the other, so this is when they're opposite, and the highest amplitudes come in, and when they accentuate the amplitude. So that's why you don't ever want to synthesize two cycles of similar lengths in a synthesis, because what you do is you introduce these artifacts when their mathematical ratios get opposite, and you also extend their amplitudes. Now, I want to get to amplitudes. Now, one thing that we did here is we didn't take logs of this data. We took the actual prices. Now, what it means is, and let's go back and look at this amplitude right here. This amplitude right here is 164 points. Now, these are real points, not logged points. And that is the average move of this cycle. Now, in fact, it's probably you have these shorter cycles, it's probably closer to 120 point move. In other words, that you would these cycles, and this cycle here, for instance, this is goes from 2020 down to 1871. So that's about 150 points. And we generally take about 10% off of these points, but in fact, that's pretty close to what we see here. Now, the reason we do that is that there is a tendency for cycles to share tops and bottoms with each other. In other words, let's put oh, it's open. Let's take the long 2-year cycle. And I got to put out 5 years, I guess. 4 years will do. These cycles at this point in time are sharing the same top, or trying to. And that works, but it tends to accentuate, because shorter cycles share bottoms and tops with larger cycles. It gives a little bit of more emphasis to the amplitude. So we take about 10 to 20% off of this number. So in general, we would argue that this 38-day cycle, we would simply multiply 164 times about 80%, and we would get about 130 points on average. And that's pretty much the way it is now. Let's just put up 1 year. So, and I don't want to see the longer cycle anymore. It's just in my way. So we know this is a more important correction, which the 38 is sharing with also the 82. And so this is usually the size of these kind of things, for instance, these swings. So if you figure from 2093 down to 1980, what did I say? Yeah, 1980. So that's about 80 points. This is a smaller version. This is a larger, but they're about like this moves, and you can estimate that move. Now, the one problem with it is we use the amplitude for the last thirds of the data. Now, in our old software, where I had full reports, and I could still do it, but no one showed any interest in the statistical side. But I was able to, for instance, I was able to print out the amplitude for every occurrence of the cycle, and you can see, with trend in it, you can see how the amplitudes grow in time. As the trend is up, or if it's down, they will shrink. So it's and it depends on the series, but in trending markets like the stock market, although you can see on this chart it hasn't done much in the last year or so, but the fact is that generally speaking, you put up 6 years, you can see that it's gradually trended up. So the amplitudes back here would be smaller, the net change. So the amplitudes, when you don't do logs, they will tend to show real points, amplitudes and real points, which is what you see here. And you couple that figure, and it's a rough figure because we have trend in it, and so the trends are altered, and what the changes in the market are when it's at 2100 versus what it's at 700 or 800 as it was many years ago that with that with that you have to be careful when you use them. And I can also, as I say, I can print out the amplitudes. Now, also, um, if you automatically printed on your, and I'm going to go take a look at it. Uh, oh, just a point I meant to say. I'm sorry about the recordings last week. I just found out, and it just reminded me that the company didn't send them out. I forwarded it to the company, but they didn't send it out, and I apologize for all that. So I'm taking care of that. I have solved the problem now. Any case, if we go here, um, boy, that's not going to work. Well, these are all the amplitudes in the spectral analysis, and I'm not sure if I'm going to get. No, that's the monthly. Sorry, I'm gonna redo this so I can show you that. Um, the I'm gonna go and do just the daily analysis, and then I'll show you the file. What I'm trying to get at is I'm trying to, yeah, there we go. I'm trying to go in and there. If you go down, and we'll go to 38. Now, what you see in a spectral analysis, I hope I'm making this clear. I may not be, and I apologize for that. What you get in the spectral analysis is um, you theoretically will get a spectral peak. See, the 38 and 38.1 are at 12,000, then 38,600, and so forth. You get a real high. See, these go up from 3,000, 8,000, 9,000. Notice they come to a peak um, here at 12,800. Now we refine it further, then they go back down in size. This is a spectral peak, and every time you do an analysis, it prints this out. And this is what we want to use. And then if you want to, and in fact, what I'm going to do is I'm going to go back and I'm going to put it in Excel, because then I can show you what I want. We'll go to, yeah, 38. we come down here to, what happened here? Funny. 1 second. That won't do. Well, it doesn't really matter on this, but here's the one. This is the high, and if we just, and this is the point, if we take this slash, this is its slope, and we put a constant on it, and then we get our strength reading. That's a very strong number, but these amplitudes, by the way, are not the same amplitudes as are reported in the program. That's the other thing I wanted to point out. This is the basis of why we picked that area to test. In other words, why did we even look at a 38.1 data point cycle and test it? It was because of this high amplitude. And if you go here and look at the 40, you have 21,000. Again, very high peak. We probably should really format it, put separators there. So now you can see 12,000. We come to the 40, and we got 21,000. They're the possibility. No other cycles are possible to test other than those. So, in other words, that's how we come to test these various cycles. And these are the numbers that are really amplitudes you can use, not the spectral. But the point I'm getting at is if we go and look at our 38, and we see that this is a different amplitude figure, and in this particular case, I haven't included slope on this type of an analysis, and it's only on the triple chart. I think I will put slope into this screen as well, so you can access it, because it's an important number. And it goes back to the Hurst notion of the of proportionality, and it's very important as far as it goes for me to read. Now, I want to go back and I want to plot the triple analysis. And again, there's no logs here. And the only way you can use amplitude, forgot, close out this. The only way you can get true amplitudes is by utilizing the amplitudes on data that you've worked with without logs. And so I have to read. Sorry about that. And that gives you some inkling of how much price to expect out of a cycle. But you have to take into account, you have to take into trend. As the market gets higher and higher, those points are depressed and expanded according to what kind of trend they're in. Now, in our case, what we use for the amplitude here, and sorry about that. I've got to redo it. I did it with logs after I rebooted the program. You hit none.
Richard?
Yes.
Is ADX a trend formula?
Pardon?
Is ADX a trend formula?
No, ADX is not. directional movement indicator. I'll put it on the screen. I'll put the ADX on. ADX is supposedly a trend indicator. I've never found it remarkable.
I was wondering if you could combine the trend formula with the cycle amplitude, and then be able to anticipate whether the moves that you were expecting, going up or down, would be
Well,
greater.
yeah, that'll give you a hint on that, and so if you go in and we'll put the heavy blue line is the ADX line, and theoretically, when it gets high, it's a trend, and so that's the theoretical part. And right now, it's fairly trendless. You can see it's right in the middle of the range. The way to use this, of course, is the crossovers. By the time the magenta, which is the positive directional index, and the green is the minus directional index, by the time they have a crossover, the trend's beginning. But this, and you really need to see more, but you can combine them if it, in this case, there's no trend at all. It's too low. And of course, that's exactly what happened. And here now, the trend's starting, but it's starting to the downside because we have and then this is, once the positive crosses over as long as the positive is below the negative, then the trend and the ADX is high, then the trend is down, and the opposite is true. Now, if you
Richard,
yeah,
this indicator is telling us about price. It's not telling us about whether the cycle is going to produce a greater price or a lesser price.
no, this does no this well, if you do no, it does not tell you. It's not going to tell you that you're going to get a 130-point move. This is just telling you when it starts. And if, for instance, in this case, where you had the crossover right here, and then the crossover here, it's telling you that length of time in cycle terms is strong enough to produce the amplitude. And that's, in other words, if we go here and we have this 104, which is basically a 21-week cycle, and we have a strength, an amplitude of 363 points. Now you have to take some away from it because of trend. You have to reduce it by about 20%. Then it's basically, if you have 363 times 80%, that's about a 180 to 190 point move. So from here, where you're sitting at 1950 to the point where you get up to 21, so that's about 160 points, and then you begin to see the positive going down. You basically say you've reached your point target, you've reached your time target, and the cycle is topping, and then you add the smaller cycle in as well, and that's the best that's the best way you can get points out of this. But it's difficult because of trend in all these markets. And if you had no trend, these cycles would tell you exactly what the point is on average. Now, there's always above average and below average moves. Now, in the second part of Vincent's question had to do with long cycles. And the real problem that I have with 400 and 500-year cycles is it's really difficult to get enough data to test them out. Our longest continuous series on a monthly and yearly basis is about 800 years. you need at least 3 to 5 occurrences of a cycle to make any estimate whatsoever about it. And in this case, that would mean on a 400-year cycle, I need 1,200 years. Well, I don't have many. I don't have many markets with 1,200 years. Now we do have some interest rate series, and those unfortunately the data interval is decades and centuries. So and the dominant cycle clearly in interest rates is over 500 years. Now he was asking about in his question Saturn-Uranus cycle and Saturn-Pluto cycle, but the Saturn-Pluto cycle I don't think is 400 years, Vincent, because Saturn is so fast. It's much shorter. But you are correct in the Saturn-Uranus, and it is very close to Armstrong's 8.6 times 50. Now, the only reason I'm bringing this up is I have no way to test this out, because aside from sorry about that, I'll read that. I finally found that glitch. I didn't have time to fix it. It doesn't affect us too often, but it's just a pain. I found it this afternoon. And you'll see that we have this is 5 centuries, so we have a 540-year cycle. We have an 800-year cycle, which is double the 400, so there could be a hint of it. And but I don't find any in the 400 range. But now we may find it in the 400 range, and the way we would do that is we think it'd probably be closer to 360 or 540. In other words, our belief is in all these cycles that the master cycle of everything is 180 years, 178 to 180, and everything ought to be a multiple of that. So it's not ironic that we have this 540-year cycle in interest rates on real data. This is actual data, but it's a century at a time, and it's not, the resolution isn't so great. The key is that you can see that this 1,000-year cycle is much stronger in amplitude-wise, and of course this is the data has problems with it. Let me put it that way, because there were usury laws until way into the end of it, and that's why it was in a range. And interest rates were set by governments. In any case, the point is, in answer, I hope it wasn't too confused, this presentation. I apologize for that. But the point is, yes, you can eke out some amplitude, but you have to remember the amplitude's affected by the trend. You take about 85% of the amplitude on the screen that's non-logged, and then you can get a decent estimate of how much price should be for each cycle. And that's the main point I'm trying to get across here. Okay, I'm going to take our usual tour of the markets, and lots going on again, and we'll I have to start again. Vincent, I hope I at least attempted to answer that. Maybe not successful.
Yes, thank you very much. Yes, that was it.
thought that was very clear, Richard, and very helpful.
Oh, good. I'm sometimes I get muddled. I was trying to
Well,
clean up.
you're not alone in that category.
Yeah, okay.
And
Okay,
I think it's a great idea to put that slope on the screen. If
yes.
you could do that,
I'm
for
going.
me as a that would be very helpful.
Yes, it is, and I think it should be there. And I have it in the triple window, but most people don't use this window. I use it, and it's here. It's called Strength. I'll change the name on both of it and get it in there, and then I'll get everybody fresh copies.
That's helpful. Thank you.
You're welcome. We're going to go and no, of course it's on this window, but not on the others. But the key to this particular cycle, and besides amplitude, and let me straighten this out by. You should, when you're working with amplitude, if you sort them on length, you should see that amplitude should drift higher. And if you want to look at real short ones, they amplitude should slowly drift higher, like in this case, from 8.58, they start getting higher, and each successive well, here we are. Each successive tends to get higher until you get a higher amplitude, and then they begin to fade again. That's a sign that there's an important cycle, and you will see this dominant cycle figure there, and you will also see the strength number top out there, and it should match with the other numbers as well. And of course, again, you can see that we come up, and this amplitude gets higher. Now this one happens to be a little less, and there is a 19 to 21 week, whether it's dominant or not depends upon particular time. We use, we can use this 19 and plot it individually. And this is, you can see this 19 is much stronger amplitude, but we're right here now coming very close to another top in the dollar. Now our view is that somewhere in December or January that we should have the final top in the dollar. And so the weekly compression is the worst compression you can have in cycles. And I'll explain that in a minute by taking you over to this chart. And we better put a cycle out we can handle here. Because of the trend here. Again, you look at these amplitudes, and now these are real small amplitudes because it's bonds. They peak out right around here, or between 6.5 to 7 weeks, and we'll just put one out, and we'll phase it up a little bit better than that. And we anticipate that right at the end of December, this happens to be Christmas, but right at the end of December that we should see the final top in the dollar. Now, we also add to that the seasonals. Now, this seasonal the seasonal in the dollar is a little different than most others, and it's been just out because of the major trend that we've seen in the dollar over the last number of months. We anticipate that this is a seasonal peak. That's why we give it December to January. But we should see it come down into probably come down over the next week or so and move on. Now, let's go right back. And this is now our back. This is our phasing, and you can see that this date here is about January 15th. Now we're going to put the, well, it doesn't matter which one we use. We'll just put the 23. That's the one we usually use. And you can see, depending on how you want to phase it, it's about first week, second week in January. We think that's the end of it. Now, what we think is going to happen here is we're just going to dip down into a trading range and below the current levels. Now, as you can see, as a matter of fact, I should go right back. As you can see, we've come way up to almost the levels we had before. I don't expect this level to be taken out, so we're very close to the top. And we'll take a look at two most important cycles. Now, the four-year cycle has been a little bit squirrely, I think. And and I'm going to put 45 years. So we anticipate a structure something like this. You see, it's a little magnified, but this is going to be the third lower high. I don't for 1 minute believe that we can move higher than these levels here, much higher. And so that's what we're looking at there. Now, gold, with the dollar going higher, gold's not going to go higher. It just can't. It won't. And we have to wait. If we're waiting for the dollar to top in December or January, then that's when gold will bottom. And this is our favorite 17, and it always shows up. It's been a good cycle. The cycles that are almost 6 months are the ones that we use. And we generally figure it's like this. We should have a move up in gold. And of course, we should have a move down in the dollar. And they're both cyclically poised to do that. So that's what we're pretty much looking at right now. And then we usually look at a 47 week, and these are a little bit out of sync. I think that by the time we get to this cycle top, that will be the end of the weakness in gold and the beginning, and this cycle will take over. It's just, in addition, we need to put our price oscillator on. And again, our key is when this price oscillator gets up and breaks through zero, that's the time you want to consider gold. Until it does that, we don't see how there's enough strength in it to break out of this low trading range we've been in. And but once it does, it will. And of course, I prefer to own silver when that happens than gold, because I think silver will go further. I mean, right now, below $15 an ounce for silver, that's pretty decent. Okay, that's gold. The crude oil. Crude oil, just like everything else, you got to be patient here. Everything is making us wait. And there is no leadership economically anywhere. Oh, wrong chart, sorry. there's no, usually economies are dominated by time and also by location. In other words, economic activity spreads across our planet. And sometimes economic activities in one place are stronger than another. And we'll start with our weekly chart, which we usually do. And this is our 45-week chart. And we are getting closer and closer to the time where we get a bottom. Now, then we go to the same cycle basically. And you can see one has a bottom in January 15th and one has a mid-December bottom. So we have them coming in crude. And then on top of that, we have to go and we put in the seasonal pattern. And you can see that we have an important seasonal low on December 14th and another on December 24th and another on the 31st. And let me just go a little further in. You can see this major secondary one on the third week in January. This or this could well be the low. And this cycle, of course, is a little bit on the short side for us. So let's put the 7-week cycle on and you'll see. And so again, we favor something around mid-December as a time for crude oil market to bottom. We think it'll be slow to take off, but our targets are at least $70 a barrel by midsummer. So that's what we're looking at crude. Bonds, I don't know what to tell you about bonds. We're all waiting for the Fed to do something. The Fed has got to do something. It cannot continue to put us through these gyrations of, it can't do anything right. That's the problem because it's gone too far. Its time for doing things right is well over. Now, we use a slightly longer cycle than that, but either one is fine. They're both the same cycle here. And this is on a short-term basis what we're looking at. This is it's between 20 and 23 weeks. This is about a 23-week cycle. So it's prices are coming down, and that means yields are going slightly higher. Now, the other cycle that we've been using for some time, well, we also, and I should put in the 52, this is the seasonal cycle. Of course, it was very unseasonal here. But that's pointing towards a low in prices in April. So the fact is it's pointing towards a rate hike, and that's a almost 52-week cycle. The other one we look at is 96 weeks, and I've got to unplug the others because it has to be rephased. And this is the phase we use, and this is arguing that we should see lower yields into February. Higher yields into February, lower prices. We don't expect a big down move here, as I've been saying for some time. We don't expect this kind of a move down at all. We just expect some sideways action. The forces that will drive yields higher will start into work in the spring, not in the next month. In other words, we've got to see commodity prices start to take off, and we think gold will start the move in commodities, gold and silver. Then it's going to switch to growing commodities. Then it's going to switch to copper, lumber, and things like this. So that's where we go with that. So let's look at the dailies. And again, the 7-week cycle is here, and so we see a little impetus for a little bit more upside activity. And then, of course, by the time you get to after Christmas, yields should be rising. And so I think that's when the Fed will raise rates. I don't know what kind of a retail season we're going to have, but the Fed has painted itself into a major corner. And the major corner has to do with they're data dependent, and the data stinks, and it can't do what it wants to do. I think they're going to have to say, data's good enough, we jack up rates by Fed funds rates. Just a minimum is what they'll do. That's it for that. Now, the stock market. Stock market is in a situation where seasonals tell us that stock markets usually correct before Thanksgiving. It's not a lot of time before Thanksgiving. So if it's going to be a correction, it's going to be a very short correction. But it also could be that it's not going to be seasonal this year. And I'll show you the seasonal plot. You can see this seasonal makes sense right to here. This move up makes a little sense based on this. But then we ought to have a drop off. Now, what it can mean is that the final low comes closer to the beginning of December than it does before Thanksgiving. So we could see a sell-off over the next 2 to 3 days. Now, if we put up a true strength index, for example, very critical right here that we see the true strength index stay below the trigger line. Very important. And for that, sorry, I didn't update. What is going on? Sorry, I had neglected to update this morning. Okay, now we're done. Sorry about that. Okay, you can see we are sitting there on the McClellan oscillator with it just above the zero line at 3.45. If you get those kind of readings and you get it right to the zero line and hang in there, market doesn't go up, it drifts back down until it finishes it. And so I think we're setting ourselves up for a decline into the next 2 to 3 sessions. And it could be that we're setting ourselves up a decline right into the beginning of December. Then what we're going to see is we're going to be making lower lows, higher lows, and we'll start making higher highs. So now we don't want to break this low too much, and that's the bottom line. We could break it a little bit, but not much more. There isn't a lot of time left, so all of these say that we're flattening out here, and this is the first time this is cleaned up. The most important thing is we got up here to 2,600 from a reading down at minus 1,000. Now that's 3,600. That is far and away inadequate for the commencement of a bull market. That's the most worrying factor. And if we go back in time to, let's go back to 2011, there we are. We were at this point in time at minus 1,000, but then the first move up, we were at 3,100. That's 4,100. We didn't get above 2,600. That's not a big move. And if we put, and I'll show you, I'll go right back. Probably the best thing is to go back into 2008. Right here, we came down and made lows in the summation index minus 4,000. And by the time you came in your first move, you were at plus 4,700 on the oscillator. That's a net change or delta of almost 9,000 issues. So that's, and of course, then we come over into 2010 where we went down to minus 300, and we started getting up to 3,800. So again, well over 4,000 issues traded. Then we come down into 2011. We're at minus 1,000, and the first peak was at 3,200. Again, over 44,000 issues, and that's what we're looking for. So right now, this came in at minus 1,000 and got up to 2,600. That's a little bit on the weak side. But if we just come down here a little bit more and then pop back up, then all's well, and then we have a bull market. And my suspicion is this will end up to be a correction in a bull market, not the beginning of a bear market. So anyway, that's pretty much what I wanted to accomplish today. So everybody, please have a happy Thanksgiving. If you have any questions or comments, please let me know.
Thanks a lot, Richard. Very good.
Thanks, guys.
Thank you, Richard.
Thank you.
Happy Thanksgiving.
Yeah, thank you very much. Bye.